Hey everybody, welcome back to the channel. Today I want to do a little bit of a therapy session, but I'm not going to be doing too much of the therapy. I'm going to have my two friends, Tom Nash and Justin O, do a little bit of the therapy session. So for those who don't know, I host a show called Money Talks every morning, Monday through Thursday. And in this show, today we decided to do a segment that I thought would be helpful for everyone, including myself, that's going through some pain in the market. I am down around $40,000 right now. I'm not it's not, I don't have any fear in saying that because I know a lot of people are down a lot of money. There's a lot of people that are down seven figures. There's a lot of people that are down 70, 80% of their portfolios. It's rough. And one of the things I really wanted to put out today is that you should not feel bad for being down in this market. You're not Nostradamus. You don't know that November is a bad time to sell. You don't know this is the top. You don't know this is the bottom. Yes, are there some more conservative decisions you can make? Are there more ways to hedge your bets? Can you DCA a bit more? Absolutely. But to just not have bought stocks over the past year and a half and think you're some genius when you know exactly, oh, May 2022, everything's going to bottom out. It's a low probability. So everyone has to deal with this situation. Everyone eventually has to be in the red. It's the nature of being an investor. And I wanted to ask Tom Nash and Justin O, who have been in the market for at least about a decade now, sort of their thoughts about psychologically, how do you deal with being in the red? And that's what I want to go through today. And I want to give my comments on the thoughts that they had to survive in this market. So let's go to this right here. We're going to play the segment. It's about 4 minutes, and I will give my thoughts along the way.
We need to have a therapy session because most of you who own stocks, if anyone who owns any assets, you're probably down in the market. Crypto hit 25,000 this morning. Right now it's trading about 28,000, down from 42,000 as it was last week. The NASDAQ is down 370 points. The Dow is down 320 points. S&P hitting 390. Things are a bit rough right now. And I wanted to set up a segment where we could ask two seasoned investors, Justin and Tom, who have been in the market for at least a decade now, about what are their best psychological tips to deal with being so in the red and having these losses. So let's start off with Justin. What would be your number one tip for someone who is down big in their portfolio?
Yeah, I would just invite you to zoom out, right? That's like the classic wisdom is zoom out, because if you even look at this year-to-date performance, yeah, Microsoft, Google, Apple are down 20%. If those behemoths are down 20% and Amazon's down almost 40% and Tesla's down 30%, like don't feel so bad when you're down 80% on something that is, or 60 to 80% on something that was way riskier, right? You took that risk.
So this point is actually a really good point. The idea that if the big guys are down 20, 30%, the small guys that are trying to be the big guys are going to be down really, a lot more than that because they don't even take up that much of the market and their stock prices are more volatile. So, and a lot of you I know are probably in those stocks, whether it's Palantir or SoFi or Open Door, and these are companies that, yes, have real big potential, but in a bear market, they're going to get hit even harder than the Apples and Googles of the world. The difference is the reward, the upside in SoFi, Open, Palantir is probably more than Apple, Google at this stage.
Knowing it was riskier than Apple and Microsoft. So now you're dealing with it on the other end and it doesn't feel so good. So, hey, welcome to risk reward. A lot of people skip the risk part of that, the downside risk part of that 2-word phrase. But also if you zoom out to the 1 year, right? A lot of these are either up or flat. Amazon's down. I would just say another thing that I've learned from when I really went heavily into crypto is I was a little bit more exuberant. I was younger. I was, earlier in my 20s. I went into Bitcoin, and then there were all these altcoins. So I actually bought some of these altcoins. And in the crypto winter, I was down 80+%. And at that point, you have to realize, if you've already lost 3/4 or 4/5 of your investment, what's another, you've already lost.
The reason I started laughing was because Justin has been through a crypto winter before. In 2017, 2018, Bitcoin was at 20K. I was in my macroeconomics 101 class when Bitcoin was at 18K. I was listening to my professor tell me Bitcoin is nothing. And I'm like, I don't know if it's nothing. It's $18,000. And then it crashed really badly. And Justin was down 80% at that time. Well, when you're down 80%, what's the difference between 80% and 90%? At that point, you just got to get through it, deal with it, and then move forward.
Lost the majority of your principal, right, at that point. But what I did do that ended up being the right decision, in my opinion, is actually converting a lot of those bad investments back into the ones that I thought were very, very high conviction, right? Like I was like, okay, so I don't actually believe in Nano. I don't actually believe in Stellar, Lumens. I actually believe in Bitcoin. So and I do think that ETH has the head start. So I converted a lot of that back, and lo and behold, I'm up quite big since then. I mean, a lot of things you have to wait, but you have to wait in the things that you truly believe in through this like crazy bad time, and it really weeds the low conviction things out. So you can do the same thing with stocks, right? If you're actually not convicted around, I don't know, Upstart, like feel free to convert that to something that you are convicted in and the valuation is much better in. So
that's the other thing I really thought was a good take, is that this idea that like, look, if you're down on a stock or a position that you don't care about, sell it, move on, and put it into something you do have high conviction on. Yes, you're going to take the loss. You could tax harvest that, and then you could put it into something where you could sleep well at night. The hardest part about this situation is not being able to sleep well at night, and the way you don't sleep well at night is if you're in stocks that you don't care about. I'm in Palantir. I sleep like a baby because you could be down a lot of money, but I'm like, I know it's going to come back, or I at least believe it's going to come back, and I think it's going to come back roaring. I just don't know when. And if I don't need that money at this moment, then it doesn't hurt me.
That's my opinion. Also, another thing I'm going to extend, and I won't have a 30-minute rebuttal, is another thing that I do is I don't mark to market, meaning I don't look at my portfolio every single day and think I'm worth that. I in my brain, I mean, this is probably just a personality thing, but maybe you can try to be like this. I tend to think about how much I'm worth or how much money I have as kind of a trailing 1 to 2 year basis or a through cycle basis. So on the ups, I'm like, yeah, that's overstated. That's probably overstated. It's too much money. I don't really think about that. On the downswing, I'm like I think I'm worth more than that through cycle. So like trying to think about how much your portfolio value is worth on a trailing 12-month or trailing 2-year basis is probably good. It's going to be really hard. That's like humans can't do it. But if we can try our best to do that, that's probably another good tip. So that's like 3 or 4 there.
That's a really awesome psychological. I've never heard of this trailing 12-month way to think of your wealth. I like that one. Tom, your thoughts on how to deal with being down in the red?
So I did like that one a lot, because this idea that, let's say you have 100 grand and it's like 150 grand. It's like, well, it's not really 150. I'm probably worth 120. So you don't get too high on your own supply. Then you get 100, you get down to 50. You're like, it's probably going to go back to 100. I'm not really worth 50 grand. And like that thing keeps you in the, I mean, like when you start dealing with big amounts of money, you can like kind of psychologically trick yourself into feeling like you're not too high or too low, which keeps you grounded. And it allows you to sort of hedge your bets a little bit better and keep you psychologically in the right situation when it comes to actually knowing and understanding your net worth.
First of all, that was a really good recap. I really liked it a lot. I think that it's a very challenging situation right now. Imagine that you're having this situation where most of your portfolio is gone, which I think at this point, more than 50% of your portfolio gone is kind of a common thing for people, right? So I would just say, and I tweeted about this just a few minutes ago, the one thing you cannot do is you cannot get into this mentality that basically generates the entire casino business, which is basically you lost, then in your head you have this 4/5 or whatever, like what Justin said, and now you have the mental entitlement to this money, so you're going to try and win it back as fast as possible so you can feel better inside, so you have that dopamine rush that you want it back. That's how casinos makes money, because when you go that route, you usually lose more money. I use the basketball example in my tweet. If I'm a basketball head, Amit as well as, so he'll tell you the same thing. If your team is down by 25 points and you're trying to get back in the game, I mean, you shouldn't be chucking 25 threes. You should be just play-by-play defense, get a layup, get into the basket, possession by possession, climb your way back into this game. That's the only strategy you have. You can't be going around trying to get everything back in a second, betting on YOLOs, options, earnings, trying to win everything back. It's a horrible idea. And for those of you, and that's a little comment to that, for those of you who haven't been around for a long time, do the math. And I mean, I have 40% of my portfolio in the S&P 500, and I always had. That's kind of a rule of thumb for me. I never deviate from that. So just do a little bit of math. For your young kids, like the 20-year-olds, if you put 30 grand right now in the S&P 500, by the time you're 50, if the S&P just does whatever it did since 1982, you're going to have $300,000 without touching it, without even looking at it once. So all I'm saying is it's not a good time to be a stock picker unless you know what you're doing. It's not a good time to gamble. It's a good time to stay in the indices and play the long game, let the indices do their thing, and just chill.
Yeah, and I think that wraps up the segment. That was ultimately, it was good advice to hear that today, even as myself, someone who's going through their first real bear market. COVID wasn't that much of a bear market because everything just came back. Everything's coming back down. If you put it into the indexes, you have your money safe, and it's betting against the U.S. economy for it to be down forever, it's likely going to come back. So that's one thing. If you have individual stocks, understand that those individual stocks will come back if you have conviction in them, and if they're decently good companies. And if you don't have conviction, then cut your losses and put them into stuff that you do have conviction in, so you can sleep well at night. And also remember that you can't win the game by chucking up a bunch of 3-pointers. You have to take it time by time. I thought that was a really good analogy. And you have to make a couple layups here, play some defense, get a couple stops, and then keep going forward in order to get back into the game. If you're down 40 grand like I am right now, you don't get that back in a month, in a day, in a couple weeks, in a couple months, maybe not even in a year, maybe not even 2 years. It's down, it's gone. The underlying thesis for me when I invest is if I don't need that money, I wasn't expecting it anyway. So I have, that 40 grand, I wasn't going to cash out until 2028 anyway, because that was a long-term bet. And if that was a long-term bet, then it's like, all right, in the short term, which is I have 6 more years till 2028, it's gone. It just evaporated. If I believe that it's the right company, that it's going to be innovative and it's going to come back over time, then that 40K inevitably will come back and it will likely be appreciated in value. And then in 2028, I can decide what's going on. But if I didn't need that money, if I don't need it to pay rent or any of this stuff, then it's just there. And I forgot about it and hopefully it comes back, which means not looking at the portfolio every day, not just dreading yourself into losses, but really recognizing that this is not the time to be scared or like depressed or anything. This is the time to remember that in order to have massive rewards, you have to take massive risks. I am starting a startup right now, and apparently the entire world and sky is falling. And this is probably not the time to start a startup. You know why? Because 99% of startups fail. But in the back of my head, philosophically, I'm like, well, I'm going to die one day. And this is probably the best time in my life I've ever had the opportunity and the energy and the market gap and the attention to actually be able to start a startup. So I'm going to do it. And if I fail, I fail. And if I don't, then it's a great bet. It's almost like betting on yourself and betting on the decisions you made and letting it ride out and seeing what happens. Not being so afraid that the world is ending that you just launch yourself into this manic state where you can't even deal with the red that you're seeing. This is the nature of how to get wealthy. This is the nature of how to build financial freedom. You have to be able to deal with these risks. And the ironic thing is, and this is why the people who make money in the market, they make money, they're able to stomach this period and actually be able to make the decisions that 5 years from now gets them financially free. And it's just a question of really going through it day by day and not having to always worry so much about what's going on, but remembering that this is a long-term game. So those are my thoughts. Just wanted to do a little bit of stocks therapy session, even for myself and for anyone who's watching this. I hope this gave some value. Let me know your thoughts on how you're dealing with seeing red in your portfolio. Looking forward to reading the comments. I'll see you in the next one.